Hi, class. Today we're going to talk about notes receivable. It's right on the back of accounts receivable. We just talked about accounts receivable in the last lecture. Today's lecture is about notes receivable. It's basically the same thing. Someone or company owes us money, just like an accounts receivable, but it's going to be a much more formal document. There'll be most likely a piece of paper signed, and a notes receivable comes about it can come out like accounts receivable. We could sell something to a customer and receive a note receivable, or we could loan another company, or even an individual money, and we could record a notes receivable. Now, there are some differences from accounts receivable. Number one, as I said, a note is more formal, note receivable, and that's one difference. Two, it's going to be usually for a longer term. The accounts receivable might be 30 to 60 days, maybe as much as 90 days. A note receivable will have a longer time period, maybe 1 or 2 years, something like that. So people have a longer time to pay you back. So you can see this when companies sell very large products, like a John Deere tractor or something. They might receive a note receivable when they sell that product, and the customer will pay them over a longer time period. And the last major difference is, unlike an accounts receivable, a note receivable is going to have an interest component. In other words, the customer will pay back the note, how much they owed, and also will pay interest on top of that. What is interest? Interest is nothing more than the expense of using someone else's money, or the income, in this case, income from someone using your own company's money. And so, and that is expressed as a percent over a time period. Interest rates, by the way, they're always expressed in annual rates, 12-month rates. Even if it's a 5-month note receivable, the interest rate mentioned will be a 12-month rate, and we'll look at some examples. Again, this is a relatively straightforward, easy topic conceptually in the math, and there's only 3 journal entries you need to know. And so let me share my screen. We'll look at those journal entries. We'll work a problem, and then we'll be done with this. And so let me pick up. Here you go. Me a little larger on this screen here. Okay, all right, only 3 entries, so easy. The day one, and I'll do 2 different types. Let's just say day one, I'm going to debit notes receivable, and let's say we sold something. Just like accounts receivable, I'm going to credit revenues for whatever that amount is that the customer owes me. So it looks no different than the accounts receivable. Now let's assume if we loaned money to someone else, we would still debit a notes receivable and credit cash. In other words, we gave them cash and we credit our cash and we debit a notes receivable. They will pay us later. And so either one of these, you can think about this, call this the one entry. We're going to debit notes receivable, and we're going to credit either revenues or maybe cash with that. All right. Now, along the way, there's going to be interest income. Every day that this note receivable is outstanding and we have not been paid back, every single day, every single minute, we are earning interest on that, whatever the amount of that note was, we are going to record interest income. Here's the issue with a note. All the income and the amount of the note, the principal amount of the note, will be paid on the very last day of the note. And so that cash will be paid back to us plus interest at the very last day of the note. But guess what? We're going to cross over some accounting periods, and we're going to have to do some adjusting entries to recognize the interest we've earned. And so when we cross over, this is entry number 2 here, entry number 1, we're going to debit interest receivable, another asset. When you see the word receivable, think asset right there, because even though they have not paid us interest yet, we have earned it over a period of time, and we're going to have to credit interest revenue. This is the biggest line item for revenue for banks. When they're loaning money, they're recording interest revenue every day a note or some investment is outstanding. And then finally, at the very last day of the note, at that point, we're going to receive cash. How much cash we're going to receive? We're going to receive the original amount that we loaned plus the interest, all the interest. And so this interest receivable has now been paid. So we're going to credit the interest receivable because that's going to be paid. And now this note receivable is going to be paid back. So but that's not outstanding anymore. And by the way, there may be some additional interest revenue in the new accounting period. And so we'll look at an example of this. Again, entry 1, debit note receivable. This is we create the note. Entry 2, credit interest revenue, debit the interest receivable for the amount we had earned as we cross over at the end of a particular accounting period where we have not been paid the interest yet. And then finally, at the very last day of the note, we receive all the cash for the note receivable, the interest we earned in the previous accounting period, and the interest we earned in this accounting period. Let's look at an example just to see, again, how easy this is. You should be just knocking this out. So we're going to do all 3 journal entries for this, even though this problem only asks for 1. So on July 1, Mean Green Company sold a large piece of equipment to one of its customers for $100,000. So entry 1 on July 1, debit getting ahead of myself there. Debit notes receivable for how much? 100,000. Credit this, in this case, we sold something. We didn't loan the money. Credit revenues for 100,000. At this point, there will also be another entry, debit cost of goods sold, credit inventory, because that inventory will be gone, but I'm going to skip that because that's not what we're talking about here. Now, this is an 8-month note. And so when is it going to be paid back? Okay, I got July, August, September, October, November, December, January. It will not be paid back until February 28th of the next year. However, let's just assume this company doesn't do monthly financial statements. It only does year-end financial statements. So on 12/31, this note has been outstanding for $100,000 for 6 months, July, August, September, October, November, December, 6 months. And we've earned interest, but we haven't been paid that interest yet. However, at 12/31, we've got to go create financial statements. We're going to have to be able to record our interest revenue and our interest receivable at 12/31. So we're going to debit interest receivable, and we're going to credit interest revenue. Now, it's a $100,000 note, and the interest is 12%. Now, I would suggest you follow this exact methodical step every single time you do one of these. What is that? That's a 12-month rate. Always interest rates are 12-month rates. So step 1, I would go calculate how much is the interest per month. So if we had it outstanding for a whole year, it would be $12,000, right? 100,000 times 12%, 12,000. How many months are there in a year? I told you the math is easy in class, 12. So the interest that the company's going to earn is $1,000 per month. How many months has it been outstanding between July 1st, let me get this out of the way, and 12/31, 6 months. So 6 months, $1,000 a month, $6,000. And that's just 6 months times 1,000 per month. So that should be easy for you to do. And then the last entry on this problem would be on the last date. And this is a 8th-month receivable. So July 1 to February 28th of the next year is going to be 8 months. And so at this point, how much cash is the company going to receive? It's going to receive 100,000 plus, and that's why I like calculating this, plus 8 months times $1,000 a month. They're going to receive 108,000. Where does the 8,000 come from? That's the interest piece. Now, what are we going to credit? Well, that note now is gone. They no longer owe it to us, so we reduce an asset with a credit. So we credit the notes receivable for 100,000. This interest receivable here that we set up at year end, that's now been paid, so that goes away. $6,000. And so my last piece is going to be the interest revenue this year. By the way, I could take $108,000 in debits minus $106,000 in credits. Oh, I know I need $2,000 to make that work. That would be easy. But guess what? What is that? 2 months times $1,000 per month. Now, what's really important here is in this year ended 12/31, we earned $6,000 in revenue. In the next year, we had 2 months in the next year where this note was outstanding, and so we earned 2,000. So this entry is really important in order to get the revenue, interest revenue recorded in the right year. That's what really matters here. So again, just 3 entries, piece of cake. There is no reason that if you ever see this problem on an accounting exam that you cannot get it right. It's easy. Remember, interest rates are always 12-month rates. Calculate the interest per month, in this case, $1,000 per month. Once you've calculated that, you can do any kind of problem that you're asked. You can do this last entry easily because you know 100,000 plus 8 months times $1,000 a month. All of this becomes easy. Do step 1 first. Thank you, guys.